Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So that increase in implied volatility is the probabilities adjustment for the options price. So we have to understand why options are expensive. As I said, great opportunity to take advantage of being an option writer, but understand that the reason why those options are expensive is because the probabilities of the underlying security making that significant move have increased. And so what this means is that as the option writer, we're actually assuming more risk. Yes, we're collecting a higher premium, but remember that this business is all about risk versus reward, and understand that the two go hand in hand. So if I'm going to get a greater reward for taking a certain trade, I have to understand that 99.99% of the time, I'm assuming a greater risk. Now, the concept of implied volatility and expanding volatility creates what's known as a probabilities distribution curve. Now, I'm kind of going back to a previous webinar that we held not too long ago, where we're talking about that change in volatility. So moving forward, if we look at the normal distribution curve of volatility, and I've just used a generic number here with, say, a pair value or an underlying security sitting at 50. Well, under normal circumstances, we would look at the probabilities of this particular security being at down towards 45 or up towards 55 as being almost equal. So in other words, when we look at the probabilities of an underlying security remaining between 45 and 55, we can see here that we've illustrated effectively a 68.2%. So in other words, there is a high probability that the underlying security within a specific time frame is going to remain within that particular price range. And you can see that as we move beyond that zone, you can see that the probabilities begin to decrease. And so we have to understand that this happens on both sides of the equation, regardless of whether we're looking at the market going up, as you can see here, 55, 60, 65, 70, or whether or not we're looking at the particular market or the value of the security going down. There is a very defined a measure of probability that it is going to stay within a particular zone, and of course the options representing strike prices within this zone are going to reflect that particular probability. So in other words, these options will be more expensive from an implied volatility perspective and from effectively a time and implied volatility are sort of grouped into the same sort of component of the premium. But these options here, whether they're in the money or whether they're at the money, are going to show a higher implied volatility as we get further out of the money or deeper in the money. With respect to our strike prices, we see that the time component and the implied volatility component begin to decrease. Now, if we move forward and we look at it as far as a situation where we're seeing more risk in the market and looking at the expansion of implied volatility, as the environment changes, volatility increases, and Steve again highlighted that earlier on. And those of you that follow the markets a little more in depthly will have probably tracked the VIX or the volatility index. Well, that volatility index is effectively tracking the implied volatility on S&P options, and so ultimately, as there's more risk in the market environment, as the market environment changes, the implied volatility expands and increases on those options, and this ultimately, of course, adjusts the prices. Now, again, very attractive from a seller's point of view because you're getting a higher premium, but understand that you're assuming more risk because that is effectively why those options are priced as high as they are. Now, just as a reminder, that rate of change in implied volatility is represented by the options Greek vega. So if you're looking to identify that, and you, depending on what broker you're with, you could search out the vega of a particular option, and that's going to tell you effectively what the implied volatility of that option premium is at the time. What I want to do here is just take a look at the idea of volatility expanding, because you'll remember that when we first we were looking at volatility under normal circumstances, we were essentially suggesting that it was a measure of probabilities, and under normal circumstances we had a 68.2% probability that the security was going to remain within this particular price range surrounding the actual underlying price itself. When implied volatility expands, what happens is you see essentially the probabilities widen out, and so where there was once a 68% chance that it was going the underlying security was going to remain between 45 and say 55. Now there's a 68.2% chance that the underlying security is going to be between 42 and 58. So what happens is that the premiums are adjusted because of this increase in probability. So that's great for the option writer who's looking to take advantage of a nice juicy premium, but the bottom line is the reason why those premiums are so attractive to sell is because there's more risk in selling them. So this brings us to, of course, the idea as we move forward as to why it's important to understand the whole concept of using a credit spread as opposed to just selling the options naked, because when we implement the credit spread, we're still taking advantage of those premiums that have increased, but we're now identifying our risk exposure. The other thing that I just want to highlight on as well, the other component that we consider when taking advantage of this type of strategy outside of implied volatility is the idea of time value. So what we have here is essentially a distribution curve that very much reflects the distribution of implied volatility in the options market. So at the end of the day, we're looking at the fact that the options that are trading at the money are very close to represent the highest in time premium, because there is a very high probability that the underlying security is going to be at, below, or very near that particular strike price. Now, regardless of whether or not we're looking at out-of-the-money options or we're looking at in-the-money options, the element of time value will depreciate very similarly, because when we talk about in-the-money options, remember that the intrinsic value of the option contract is actually beginning to override that component of time depreciation, and so as a result, the time value will diminish as you go deeper in the money, and the time value will also diminish as you go further out of the money. When we're looking to select the appropriate option contract to utilize in a spread strategy, the bottom line is we want to try to take advantage of the option contract that is giving us as much time value as possible, but is also exhibiting a characteristics that suggests that there is a high probability that it's going to expire worthless. So if we look at an at to slightly out of the money option contract, we're going to collect all time premium. And if we look at an in-the-money option contract if we're the seller, we're also going to be collecting intrinsic value. We're going to get an even higher premium, but we have to understand that option contract will continue to have a value until it actually drops, until the option contract, till the underlying security actually drops below the strike price.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.